Is this the end of gold's bull run? We'll be looking at part 2 of Gary Wagner's series on Chart This. As always, joining me from Hawaii, Gary Wagner. Thanks for being with me.
My pleasure as always.
Gary, if you were acting as a doctor right now, what diagnosis would you be giving gold? We saw what happened when silver broke through its range earlier in the week. Is gold up next?
You know, I don't know. It seems like it's in the critical care unit if I'm a doctor right now. Gold's been under enormous pressure. It's currently threatening support, which is just at around 1537 to 1535, which is major support. Those are the lows that it hit just following the first record high above 1900. But it's not reacting in a traditional manner as a safe haven investment.
Gary, and that's exactly what I've heard from other analysts, that gold is no longer acting as a safe haven, but you would think with North Korea, with Cyprus, why is it not responding to these events?
Well, you know, it's all investor mentality, and on the surface, they should have an impact, but the impact that they have is certainly not been nearly what many analysts expected. At the same time, you have a raging U.S. equities market, and my sense is that a lot of money has come out of the commodity sector and moved into equities. These fund managers need to perform, and when you consider equities are up 11% or were before this sell-off today, but up 11% this year, and compare that to the precious metals performance, it's not hard to see why money is moving from the metals to the equities.
Gary, you're touching on a good point now. Earlier in the week, the Spider Gold Trust, that's the world's largest gold ETF, saw its holdings fall by a further 4.2 tons. Large outflows of ETFs here, Gary. Is that the number one moving factor of gold?
That and the relative strength of the US dollar are the two major factors, I believe, that are genuinely putting selling pressure on gold.
Gary, and I'd also like to pull up a report from the CFTC last week. Let's look at gold futures and some key numbers that you look at as a trader.
Yeah, of course, every Friday, and it's a free service, you sign up with the CFTC, but they'll send you a link to the most current report called the Commitment of Traders across the board for the commodity sector. Of course, I'm looking at the metals. What we saw, even though the markets were closed on Friday, the report was still issued, and we saw a tremendous liquidation from managed money on the long side of gold. I believe the total was about 10,000 plus contracts were actually gleaned or removed from those portfolios.
10,622 to be exact, Gary. So those are the key numbers that you're looking at?
What I look for personally, the report breaks down the commitment of traders by sector. So you've got the manufacturers, you've got those that are hedging their need for either purchasing gold or providing gold. And that to me is not a speculative endeavor. They're simply looking to curtail risk, and that's why they use the futures markets. The other end of that is a speculator, and the largest component right now is managed money. And so when you look at the managed money part of the report, you can see that they liquidated roughly, I think, 16 or 1,700 contracts. Each contract's 100 ounces of short positions, but they also offset over 10,000 long positions. That's 100,000 ounces of gold.
And one last question before we get to your insert, Gary. Earlier in the week, Soc Gen, Societe Generale, making a statement that we may be on the verge of a bear market in gold. When banks go on the record with these type of statements, does that concern you, Gary?
The statements don't concern me, but the recent price activity, the prolonged correction that we have seen does concern me. The key is this: I truly believe that gold, along with other markets, follow a natural cycle, and that cycle has peaks and valleys. When you consider the fact that we've watched gold go from roughly 700, and I'm talking about 2008 prices, to 1900, tremendous rise, and then retrace about 23%, that doesn't signal the end of a bull market. However, the bears can only be seen as increasing their power and authority right now because they have had control of the market for the last 6 months.
All right, Gary, let's get to part 2 now of your series on is the bull market run over?
Okay. You know, the big question, obviously, on metals traders and investors' minds is whether or not we have really seen the last of this bull run, a bull run which really kicked into gear in about 2008, but actually began at about 2002. First of all, we're absolutely in a critical area. And what I've got up here right now is a daily chart. It is a continuous contract of gold, but I've put a fib retracement. And the fib retracement is basically going back from February of 2011, silver's trading at about 1,300 to the record top of 1,900. So this is that $600 move. And when we run our retracement, a 61% retracement of that move is 1566. And as you can see, the market in fact broke below that today. But we are still within a very loose set of parameters because we have had lows that have gone as low, I believe, as about 1520 right in here and here. My band of critical support that I'm currently looking at begins at 1520, 22 to about 1535, and let me show you how I arrived at that. I'm going to pull up another chart. This is a weekly chart, and this weekly chart has both MACD, moving average convergence divergence, along with a weekly candlestick chart. And there's a couple of things that we notice, but let's go ahead and change this pointer here and move this over just a little bit. I've basically run 2 different fib sequences or time cycles. As you can see, one is running from about 1180 to this record high. 1142 is the bottom of the first one, and then right at around 1280 or 1300 on the second one. So I'm pegging it from these 2 lows. And I look for what I call Fibonacci harmonics, which is where you'll get 2 different time cycles basically coming out with the same conclusion. So a 50% retracement and a 61% retracement is right within the realm. 1522, 1510, these are a series of bottoms in the marketplace. And my sense is that if the market cannot hold this particular area, my fear is that the next logical place is around 1430, 1432, and that's based on a 61% retracement of this large move or a 76% retracement of this much smaller move. Now, one of the things that I found interesting, and let's go ahead and enlarge the moving average convergence, divergence. Let me shrink this chart in a little bit. As I was looking at this, I noticed something that I find very interesting and possibly very revealing in terms of the market itself. If you look at the moving average, the MACD, there's only been a couple occasions where the market got extremely oversold. In other words, went into negative territory and then crossed. One right here, which is October of 2008. And then we never had it go into the negative numbers really until about April, June, and July of last year. Now, let's take a look what kind of move we saw. This particular move right here in October, we saw the market, which had hit 1,000, retrace. This was that heavy correction where it retraced back to 700, and then we saw it really rally back to 1,000 and then go new price high, new price high, new price high. If you look, the market never went in anywhere near negative territory really for the next few years. And then you saw it begin to dip back in, as I said, April through July of last year. Now, you had this one break, And as you can see, this was a pretty good signal when we look at it, because this was buying the lows and covering at about 17 to 1800, about just shy of 1800 is part of this triple top. So we had 2 occasions on a weekly chart. And what I find interesting is this is the 3rd time we've really seen this formation. In other words, have it go into extremely oversold territory and then cross up. It attempted to do that right here, but it couldn't follow through. That to me is very significant. So what conclusions can I really draw from that? Well, the first thing is that the verdict's not in whether or not this bull market is ended. Certainly when we're looking at price declines, as we've seen recently, there is no doubt the market's not doing what it used to do. It's certainly moved away from the types of parabolic moves that we were witnessing. But when we consider that the market has genuinely come from, the $400 area to the $1,900 area, and has done that in really just a little over a decade, you have to acknowledge the fact that some sort of correction and corrective action must take place. What I find to be most fascinating is the fact that we have a scenario that has not occurred that often within the gold market, and yet we're seeing it occur right now. That to me is pretty exciting. Now, this is a 2-day chart, and it is the cash market of gold. And as you can see, I also have the moving average convergence divergence up, MACD. And on a 2-day chart, the occurrences are a little bit more frequent, but not all that frequent. You have 1, 2, 3, 4, and then our current cross right here. And if we look historically at really what the market was pointing to in terms of was it a relevant buy, would have it worked out? I'm going to try and line these up as straight as I can on the cross so that you get an idea. It's not picking it perfect. So now it hovers just at around 0, but it doesn't really dip into negative territory till the beginning of 2012. And then again, June, July, and currently. Now, when we look at this technical evidence and these studies, there's no doubt, very, very strong buy right in there, very strong buy signal there, very strong buy signal there. Will this give us an indication of what's to come? I can't tell you for sure, but I can tell you, based upon historical market observation, this could be a really, really dynamic time to consider entering the market from the long side. Has the bull market ended? I'm not convinced it has. And I think we might be on the edge of a really nice move to the upside. Now, I have to have a caveat to that, and the caveat is I no longer am filled with optimism of going to 2,000. But I'll tell you something, at 1560 or 70, if we caught a move back to 1,700, it's a nice move. Again, moving average, convergence, divergence, and the relationship with gold. I want to thank you for spending the time to view these videos and hope that you gain some insight and value from that. To that extent, you know that I typically will offer those that are interested in diving into these topics a little bit deeper, some bonus content, some additional content to whet your appetite. This week is no different. Simply go to our website, thegoldforecast.com. I want you to look for the little copyrighted C in the upper right-hand area, and that will take you to the Kitco bonus content section. And this week, I think you'll like what you're going to see. I did a webinar last week. It's an hour webinar detailing really the evolution of the techniques that I use, how they came about, and really the practical results that we have seen with them. Please join us and watch our most current webinar.
Thanks for that, Gary. We look forward to seeing you next week.
My pleasure, my pleasure. And my hat off to Jim The new segment that you guys have where you are actually publishing stops within the gold market is going to be an exceptional value to the viewers, readers, and followers over at Kitco Metals.
Gary, I'll be sure to pass along that message to Jim Wyckoff. That is the latest feature that we have on Kitco.com for our viewers. And thank you all for watching this installment of Chart This with Gary Wagner. You can email us any comments or questions at newsfeedback@kitco.com or follow this conversation at Daniela Camboni. Thanks for watching.